Welcome to part 4 of tonight's program of the Opportunity Zones Meetup. Our topic tonight is setting capital goals. In the last 2 sections, we talked about preliminary steps, predecessor steps, where first we're going to create a list of everything we need in terms of capital in order to achieve our milestones. And we broke that down by the type of capital. We didn't just limit it to a cash symbolic representation that we're going to spend a number of dollars. We're saying what kind of capital we're actually going to utilize because this level of sophistication analysis enables us now to look at more and different sources of capital, which gives us more choices and a higher probability we're going to find somebody who wants to make that capital available. Then in the last section, we started trying to identify, are there sources for those types of capital? Sometimes a business will need something and cash is the only answer. And in that case, then they're going to have to go through everything we're talking about in a classical campaign of raising cash in an opportunity zone fund into a fund and dropping it down into the business. But if there aren't enough people with capital gains, then we want to look at an alternative or complementary fund in order to make sure that we still got money coming in the door. And it actually broadens the spectrum of who's available, kinds of money available, still in the cash mode, and so on. But if we get to the point where we break it out by people, equipment, all the other types of capital, it just gives us that much more flexibility, that many more options. And as it will prove out as you get into the capital campaign, it also improves all your ability to raise the capital. So we get into this third part. Now we're going to talk about setting the actual capital goal. So we talked about what you need as being a shopping list. And the people who have the capital are like the stores where you would go shopping for these particular things. And at this point, we're saying we need to make some decisions on what we need from who, in what amount. We're still talking at a fairly high level. We aren't necessarily talking about ABC company on 5th Street or I'm going to go to this program over there. We'll get to that level of detail later. Right now we're saying we're going to have to start framing the size and scale of this because the size of the campaign will start dictating how much time and energy we have to invest in the campaign. And it also may demonstrate that maybe we're not ready to raise capital or we have some weaknesses in our thinking or we need to go back to the drawing board because we're not really understanding our business all that well. So at this point, typically you're talking about 2 things, a minimum goal and a maximum goal. A minimum goal is those resources you need to hit a specific milestone. And in our needs analysis, we would have delineated all the milestones between here and 10 years down the road when we do an exit. We could have picked any point along that path and go, that's going to be the milestone we're going to use. And then we're going to look at the assets, the resources, the capital we need to get to that milestone. And that would then represent what we would call our minimum campaign goal. Anything less than that means we may come up short, we don't attain the goal, and we may find ourselves without the resources to move forward. So we're going to define this a little bit more thoroughly. A lot of people define minimum goals the wrong way. They go, okay, worst case scenario, what's the least amount of resources I can get away with? And this is raising all kinds of red flags and setting the table for potential disaster, because if you jump from one cliff to the next cliff and you miss it by this much, you still fall all the way to the bottom. And so when we talk about getting to the goal, we want to make sure that you have enough resources to attain lock and, almost with a high level of certainty, attain that goal, not something that might get you there if everything goes right. Entrepreneurs, by and large, we're all overly optimistic. We all think we can get it done. And the rule is you always have to double your time or double your cost or double something because we're too optimistic. You want to be thinking now from a conservative standpoint, what is it I need to get to that goal? with a high degree of certainty. This is what I was mentioning earlier. You don't want to think in terms of minimums as minimum, minimum, minimum. You want to think in terms of what's necessary if things don't go right. So you want to leave a cushion. You want to make sure that you've got a fallback in your strategy. When they talk about doing a pivot without funding, without resources, is not a pivot. It's basically a death dance. Your business is finished. There's nowhere to go. You don't have the resources you need. So since things don't often go well or right or fast or optimistically, what do you need to get to where you want to go? And what do you need to do if you need to take a slight detour? What if you're delayed by 6 months? What if something else happens, you don't get the permit you need? Are you all going to camp in your car for 6 months until the money shows up? What are you looking at? You want to take that into consideration in setting, again, a minimum goal. The other thing that is often forgotten, and this is true in technology companies and development cycles, they're going, well, as soon as we get our first prototype done, so they set the milestone for completing the prototype. Completing a prototype generally doesn't result in any revenue to the company. You have a really good-looking widget that works, but there is no money coming in the door. Now, with that widget, you may be able to attract more capital, but if you don't have the money to do the next capital campaign, you're still sitting there with a widget that's pretty cool, but no ability to raise the capital. So I always say, when you talk about a minimum goal, knowing that you're going to go through multiple capital raises over time, you want to make sure you attain your objective, and then you want enough money to go raise money at that point with your new status as you move forward. We start talking about a maximum goal. This is what you need to get to your milestone. Now, along the path, you've got more milestones ahead of you. You're saying, okay, if I set the minimum goal here, then what's the next milestone or 2 milestones down the path? That would be a suitable topic for a maximum goal in the same capital campaign. Now, we don't want to go too far down the path because there's reasons why that's not the best use of your time or money to raise all your money up front. If you go on further down the path, what you're going to find is that your perception by the investor is, oh, this company is more mature, there's less risk, higher greater probability of success. That means the value of the company has increased, and so if you raise all the money early when you're a high-risk business and likely to fail, you're going to pay a higher price for it. So as you're looking at your different milestones, you're also asking yourself, how's the investor perceiving I hitting this milestone? This is your 3rd anniversary, you may not care. This one is I got a major government contract, may care a lot. And if they care enough and it increases the value of the business, then you want to raise enough money to get you to that milestone and raise the next money, but you're going to set the price higher during your next capital campaign. So we are again doing some analysis of knowing that we're going to be raising money along the path. There are certain points where we hit a milestone and it has a major impact on the potential value of this business. And if there is that major impact, let's not raise money beyond that point, because we're going to be able to increase our prices, give up less equity, pay a lower price for the money because of that nature. A lot of people, a few people I'm talking to are talking, well, I'm going to go a hard money lender. Well, that's expensive money. You want to do it for a short period of time. You want to hit a milestone with that money that allows you to refinance that with lower cost money, which would mean, again, that less cost of money, more profits, more money for investors. Now, one of the things, as you get into the more mature companies, you're making some profits. Depending upon the business, this may be immediately out of the gate, it may be a few years down the road, but the profits you earn are then part of the capital that's available to you. So if your early analysis said, I need cash to get to this milestone. Some of that cash may come out of your profits. But I've also seen this, again, where over-optimistic thinking says, well, our profits are going to be this high at this point in time, and therefore we're only going to need to raise so much money because once we get there, our profits are going to fill the void and we're going to be able to get where we want to go. If you don't hit that level of profits, or the profits don't show up at the time you wanted to, or they're trapped in receivables where you can't touch them today, you're going to have to spend money to either finance that difference or to factor that paper, and that's an additional cost of capital. So as you're thinking through the milestones and you're saying, I'm going to displace a portion of my capital goal with profits from the business, make sure that's a reasonable expectation and it's not going to create a hardship for you when you get to that particular point. So what we've come to at this point in tonight's program is that we've talked about setting a capital goal as an essential part of the capital raising process. We've defined 3 distinct steps or skills, as I would call them, that we're going to teach in our boot camp on raising capital. The first 3 weeks will be the same topics we covered tonight over a 12-hour time period. And it'll allow you to dive deeper into this, to personalize it to your own situation, to understand it in greater detail, and see how other people are dealing with the same thing. But with this, at this point, to give you a forecast or a movie preview, so to speak, now that I know what I need, now I know that there are sources out there, now that I've figured out pretty much what I want to do in the immediate term as far as raising capital, I'm going to work towards doing a capital strategy. This is my thought process on who I'm going to talk to, what I'm going to ask them for, why do they care. So in getting to a final capital strategy, we're going to start identifying people who have the capital, and we're going to start profiling them based upon their motivation, their willingness, their desire to make that capital available to us, and the reasons for that. So we may end up, initially with a catalog that's thousands of pages representing hundreds and hundreds of different types of capital sources. But at the end of the day, we don't have the time or the need to talk to all of them. We just need to talk to enough of them that will give us the resources we need. And if we're going to just talk to a few of them, why don't we start with those who really want to give us that capital, rather than people who don't care or trying to go through evangelist type of conversion. Oh, you should love us because we're lovable, type of an angel pitch. So we're going to create a strategy, and the strategy then will set the framework, the guidelines, the thinking, the rationale, all goes into the strategy of here's what I need, here's who has those resources, here's who I'm going to select amongst those resources, and it's all based upon motivation and understanding that I can give them something that they need and want in exchange for what I need and want in terms of capital. So the next 2 sessions, the 4 and 5 in the workshop series, are going to be on profiling capital sources, and then we're going to get into actual framing the strategy. Because what we've also seen, and this is unfortunately a trend that's continuing, it used to be, well, I needed money 40 years ago. I'd go down to the bank, I get a loan, I have all the capital I need, it's in cash, it's simple, it's straightforward. As banks become risk adverse and can't do risky things, that disappeared. We've seen angels step up into the gap. Wealthy individuals, usually working on their own initiative and with their own motivation, which can be all over the place. And that's nothing against them. They all have their preferences, and we encourage them actually to follow their preferences. But that doesn't mean they're going to like you or what you're doing or want to give you the money, or they may not have any money currently. So we have to look at other sources, and opportunity zones now has come up as yet another potential source. So if I go to someone who has a capital gain and they want to get a tax incentive out of it, I still look like every other investment that's out there, and I'm competing with everybody else for those desperate dollars from Opportunity Zone investors. So amongst that set, can I break them down? Do they have a preference? Do they have a motivation? Because I only need to talk to those who care about what I'm doing. I don't want to talk to anybody who doesn't care about what I'm doing. And we're going to talk about what all the different motivations are, why would they care on a cash basis, but we're also going to talk about non-cash. One of the things that we find in looking at opportunity zones is that it's intended to help distressed economic communities get better, to catch up, to improve the local economic health of the community. And therefore, the people who are making opportunity zone investments who are going to be best are those who care about the community. Now, this creates some good news and some bad news, because if they're in the community, we can start quickly coming up with non-monetary reasons why they should make an investment. It's going to create new jobs, it's going to contribute to taxes, may support the local charities, help the schools out. These are all good things. The person says, I don't have to make that much money off of my investment because it's helping my community, it's helping me directly or indirectly. But if I start raising opportunity zone money from outside of my community, where's the benefit in that? And this is one of the challenges we're seeing a lot of communities do. It says, we're going to put together an opportunity zone fund, and similar to a business, they're anticipating people are going to drop money into that fund because they have a fund to get the tax incentives. But they're forgetting the fact that there are 8,700 other opportunity zones. There's lots of more communities looking for money, and there's no real reason for somebody in New York to put money into a small community in Colorado. None whatsoever. Unless that community is doing something unique or distinctive or something that stands out that makes them attractive to the person who's making that investment, in which case they're doing it for a rate of return, but for a second reason. And if you don't have that second reason, they can't make that decision, that differentiation. If you can do something that adds to that. So let's take an example, Grand Junction, which is doing an excellent job out there promoting opportunity zones and recruiting. They've set up an industrial park with the theme of outdoor recreation. This helped support actually getting the Bureau of Land Management offices moved to Grand Junction with jobs. So all by itself, even before the park is filled out and full of tenants and everything else, they demonstrated that there's a commitment in the community to this particular industry, which led to government resources being allocated and relocated into their community. The community's already benefiting. Then as they recruit more businesses in, and Canfield Banks, Bicycles, just announced they're moving their headquarters to Fruita, which is part of the Grand Junction Mesa County thing. That's part of this larger effort. So now they've got a new company relocating, bringing their employees, and so forth. And this is building. You can see them with a theme, being focused. Focused in this way is attracting people to move businesses, to create the jobs which are the core, and then from there they can work on workforce housing, they can work on skills training, they can work on these other elements. So as you were doing strategies, we've been talking about this pretty much at a project level, but what we're seeing as we go through the maturation of opportunity zones was first a wave of real estate, now we're seeing businesses on the rise, but ultimately we're going to see what we call community projects. This is not defined in the statutes, not in the rules. This is our interpretation of how this all will work best, and that a community project will have to be a private sector business in partnership or some relationship with one or more businesses, and probably working with a government agency or charity or both in a public-private partnership. And these are likely to be focused on infrastructure issues in the community, whether that's housing or utilities or telecommunications or something else, where the community is having problems figuring out how to get these things funded. And opportunity zones may be the catalyst to make it happen, but one business by itself isn't going to make that work. But if they team up within the community and it's a community-oriented project, we think it has greater strength, greater sustainability, and it will create greater impact on the particular community. And we see this as being the third wave that will start sometime this year and grow over the next few years. as what might become the more dominant type of investment, because everybody in the community is going to benefit from this. So when they're talking about raising money into this, there's clearly a monetary benefit. There'll be a non-monetary benefit at some local level. And then the question will be, as we talk about strategies, how do you create a benefit to somebody who's not in your community? How do you get them to support you for some reason? What is it you have in common? What affinity you have? What motivation you have? And this is going to require even greater nuancing to try to figure out how to identify it, quantify it, package it, communicate that to those people who may be scattered all over the place. So great challenges yet to come, but now we're laying the groundwork to approach this so that at a point where we need to do something better or more, we have a rationale for it and we know where we need to jump off to make that happen. So this concludes part 4. We have resources on the slide deck. So that brings us to the end of part 4. I am going to walk through tonight. I don't do this every event. Some of the resources that are available, we've added a number of new sources to the list that I want to bring to your attention. And these are other groups, other organizations, other individuals who are doing good things within the Opportunity Zone, are considered a source of knowledge and something that you may want to pay attention to. You'll be getting the slide deck tomorrow morning, so you don't have to worry about rapidly writing down everything I say or talk about. But the state of Colorado is continuing to be a major advocate for Opportunity Zones, and they are going to be putting on a conference October 1st. They're putting together the program now, and we'll see how that goes. But they've come out with some new programs. For those of you who are service providers, they are creating a directory now of all the service providers in the state who are supporting Opportunity Zones. Just came out this week. And there are some new micro programs to help them, which I'm still trying to, are going to be announced next week, I guess, or in 2 weeks.
So that's a grant up to $2,000?
Yeah.
What is that? Sorry.
I don't know. I asked the question, and I have not been able to get a total answer to that yet. Then we have Ross, who's here tonight, who has created his own mapping of Opportunity zones within the state of Colorado, and has additional data beyond what's currently available at the state, which give you a better idea maybe about the community where the Opportunity Zone is located. So Ross is continuing to help us all out there. We then have the video recordings. All of you are familiar with the fact that every one of these events is recorded by Steve Maltz with AdCom, who does an awesome job. And typically within a week of the event, a week to 2 weeks, we'll get all the editing done, and it's posted up on YouTube, and we'll notify all of you when it's available and give you all the links. The video for the last event will be posted. It's already posted, but it'll be labeled correctly with the right descriptors and hashtags sometime tomorrow morning before I leave town. Then we have a Facebook group. This is a relatively recent group that has come in under Opportunity Fund. They're sharing information and stories and so forth, and you can get a slightly different perspective, different look at the Opportunity Zone industry as it's evolving. We have the Oz Guide, which is put out by Mendora. And it's a pretty good ongoing source of information. Again, it's kind of like a newsletter or news magazine that talks about different projects going on. That can be a good place to look for ideas. This is the one I announced just a couple weeks ago. No, this is a new one. This is the Council of Development Finance Agency, CDFA. If you're doing anything in terms of economic development, urban planning, financing in a community at the municipal level or whatever, this is a top flight blue chip organization that puts on awesome programs all the time on this area. They're the ones who hosted the program on PACE financing yesterday. It's a 4-part, 8-hour program on PACE. and it was free. A lot of their stuff, there are price tags associated with it, but good quality, completely comprehensive and funding municipal projects of any shape, size, or form. Then we have this one. This is the directory that was published a couple weeks ago by the National Council of State Housing Authorities. This is a list of all the known opportunity zones that they're aware of the funds. So if you're looking for funding, you may find money from this source that aligns with your particular project. Now, most of these projects are hyper-local. A lot of them are very fixed or siloed as to what they're willing to look at, so your project may or may not be something of interest to them. But again, if you're getting into something that has either replication potential or it may be impacting a social cause, you may find something in here that matches up with you. So this is, as far as I know, it's the largest list of Opportunity Zone funds that exist in the United States. Then this is the Global Institute of Innovation Districts. As we've been working on embedding innovation into opportunity zones, this is a group that recently formed, and a lot of them are spin-offs from yet another institute, who's been doing work on innovation districts as a organized, local, hyper-local effort to instill economic growth based on innovation. And they just formed this new group, and they're getting more active into opportunity zones as it crosses over with what they're doing.
Is this in Colorado, or do you know where this is?
Most of these people are out of the East Coast. I'm sorry, I can't recall the group they were with before, but it was more of a household name, large brand institute that does a lot of think tank stuff. And I've been following the work of the individuals for several years. And I think that they're going to, again, bring some new insight, different perspective to how you might want to look at an opportunity zone, regardless of where it's located. And then there's me. So last but not least, we have our meetup group. This is the link to it. We have a library which is in development, and with Nate's switch to more incentivized work, we're expecting to see this improved a lot. And then I'm available for contact on working with the zone. Right now, there are lots of things going on. The knowledge base is increasing. The growth in opportunity zones is geometrically going up. It's looking more and more like a hockey stick all the time. And as more people become familiar and the communities get involved, more businesses jump into this, I don't see this thing slowing down for the next 2 to 3 years because the incentives are still on the back end, and they're still there for the having. No, this is, you'll find, we're going to do more of these sessions as we work our way through jumping into other issues and other topics on opportunity zones, that having this fundamental approach will help you in thinking, what do I need, who's got it, why do they care, what kind of deal do I need to make, can I afford to make that kind of a deal? And then by the time you get around to actually making a pitch, this isn't throwing stuff against the wall. I'm talking to that person because they actually love me more than I love myself. I have something they want, so when I ask them for what I want, we're going to do a deal. And it shortens the process. One of the things that we've been asked about is they're going, well, how much does it cost to do a capital campaign? We go, well, if you throw stuff at the wall, the cost is infinite because you'll probably never succeed. There's an unlimited amount of money still going to get you to failure. If you do it in this process where you're looking at motivations, you're going to find out that there's probably 20, at most 50 people that you need to talk to who have a reason to give you the resources you need. That makes the campaign straightforward, manageable, and much shorter in duration than it commonly is. And it's probably going to give you a much higher level of success. So we're going to be dealing with that more throughout the year while we're diving into specific projects and taking on some of these interesting aspects of opportunity zones. So thank you all for coming tonight, and we'll see you in a couple of weeks.